Now that you've seen the introduction to this training, let's get into some specifics about the credit card processing industry so you can understand how it works and how you can make money opening your own credit card processing business. First of all, you're going to hear three terms used to describe our industry. They are all used interchangeably and mean virtually the same thing. You'll hear it described as the merchant services industry, and they use that term because of the word merchant. A business owner is considered a merchant, and so merchant services are services provided to merchants. And that's some terminology we use in the industry. You'll also hear it called the credit card processing industry for obvious reasons, and you'll also hear it more broadly termed electronic payment processing. That is because in our industry we also offer electronic check processing. Ever been at Walmart and you write a check? They don't just take your check, they run it through a scanner and they convert it into an electronic payment form, and we also offer those services. And we also offer services like gift cards. So the broader term is the electronic payment processing industry. Now, to begin with in this training, we're going to deal specifically with credit card processing. So that's what I'm going to use, the terminology I'll use most of the time. Let's talk about the credit card processing industry a little bit. Here's how it works. Let's say a business owner has a credit card terminal. Maybe it be a convenience store right around the corner from your house. And you go into that convenience store and you spend $100. Now, when you spend that $100, you can choose to either pay with cash, with credit card, or with check. Now, let's say that you choose to pay with a credit card. You pull out your Visa card and you hand that over to the business owner or merchant and ask them to swipe your card as payment for the $100 in goods and or services that have been provided to you. What many customers do not understand about this process is that the business owner does not receive the entire $100 that he processes through his credit card terminal. When you hand him your credit card, he swipes it through the terminal and he punches in $100. On your credit card statement, what you see is a debit for $100. In actuality, many things have happened during that transaction and in order to make it possible. First of all, when the merchant swiped your card, the first thing that happened was his terminal accessed the Visa network and wanted to see if the money was there. And that's why it comes back up on the terminal approved or declined. That's because the Visa network was accessed and the Visa network looked at your card and said either you do or you do not have $100 of available funds to fund this transaction. When it comes back up accepted or approved, then a couple other things happen. That transaction sits in that merchant's terminal until the end of the day. And at the end of the day, they take the entire amount of transactions for that day, and that would be called their processing volume. So if they processed 10 transactions for $100 each, their daily processing volume would be $1,000 for that particular day. At the end of the day, they do a batch. Now, when a merchant batches, or also what's called settles their terminal, what happens is all of these approved transactions that are stored in their terminal, at the end of the day, those all are taken from their terminal, sent to a credit card processing company, and that credit card processing company funds the merchant's bank account that amount of money. So in this case, 10 transactions, $100 each, that's $1,000 of daily processing volume that has been swiped through the merchant's credit card terminal and approved. Those transactions are then settled or batched at the end of the day, and all of those transactions are sent in one lump sum deposit to the merchant's bank account from the credit card processing company. Now, you might ask, why wouldn't the merchant or business owner deal directly with Visa and MasterCard? Why do they need to go through a credit card processing company? Well, there's a couple reasons for that. First of all, Visa and MasterCard do not fund those transactions for several months, sometimes as many as 6 months. So obviously a small business owner would not be able to take credit card transactions for 6 months and never receive any funds for them. Because of that, Visa and MasterCard have decided only to work through approved ISOs, independent sales organizations, to fund those transactions. So essentially, what a credit card processing company is doing for a merchant is essentially funding transactions that they run through their credit card terminal. Then Visa and MasterCard pay the credit card processor the amount of money that was processed through that merchant's terminal several months later. So when you really strip credit card processing down to its core, it's basically a financing business. Merchants come in and swipe the card, and all those transactions are sent to the credit card processor. The credit card processor then deposits the money into the bank account within 2 to 4 business days of the transaction, and then the processor waits for Visa and MasterCard later on, several months down the road, to actually fund the transactions directly back to the processor. Now, a couple of the things that happen out of these transactions. Let's go back to the example of you running your card for $100. There are additional fees that the merchant or business owner will pay on that $100 transaction. First of all, they're going to pay interchange fees. Now, an interchange fee is a cost that is charged from Visa and MasterCard, and it depends on the card type and the business type and the way that the card is run. Let me give you an example. Let's say you pull out a Visa debit card or check card. Now, that is a very low-risk transaction for Visa and MasterCard, because over the network, they're going to see if the money is actually in your bank account, and they're going to realize it is in your bank account, and if it is, they're going to approve the transaction, and they know that the funds are there. However, if you run a rewards card, let's say you have a Visa JCPenney's rewards card, and you choose to use that card in a place of business. On that card, you might receive 2% cash back or 1.5% cash back. Did you ever wonder who is paying that 2%? The business owner or merchant where you use the card. They are the ones that are paying that fee. And so for them to accept that Visa card, they are going to pay a slightly higher fee, what's called an interchange cost. The interchange fees range for all of the different card types. And so because of that, there are literally over 400 different interchange fees. I know that sounds complicated, but I'll simplify it in a minute. Now, we have 400 different interchange fees that are charged from Visa and MasterCard to the credit card processing company. So that $100 transaction that was run, let's just say it's a regular Visa credit card, and you run a $100 transaction, and let's say that the interchange fee is 2%. So out of that $100, the Visa is going to charge the processor 2% or $2 in order to process that transaction and fund the transaction to the merchant. And again, that 2% is used by Visa to cover things like chargebacks. It's used to cover all types of different risk. It's also used to cover things like rewards programs and things of that nature. Now, that $100 transaction has now gone through, and the merchant has their money from the credit card processor. The credit card processing company also charges fees to the merchant in order to facilitate that transaction. So not only does the merchant pay an interchange cost or interchange fees directly from Visa, but they also are going to pay some processor costs in order for the processing company to fund this transaction and basically assume all the risk for the transaction for several months until Visa and MasterCard fund the transaction to the processor. So when you swipe your $100, you didn't realize all this was happening, but actually a lot is happening. First of all, the network is accessed to make sure that the funds are there. That's why the terminal dials out. The merchant is charged a very small fee to access the network. Then, in addition to that, after they've accessed the network, there are fees that they'll pay in interchange costs that have to do with the type of card that's being used, the business that it's being used in, and also the way that it's being run. Is it being keyed in or is it being swiped? through their terminal. Then the processor who is actually funding the transaction, they also have fees that they charge the merchant to slightly mark up the transaction from Visa in order for them to make a profit. Now, let's go back to the $100 transaction, and I'll give you an example so you can understand a little bit of how it works. First of all, for some statistics, the average merchant processes $11,000 through their credit card terminal each and every month. So that's their processing volume. Now, their store might do $50,000 a month in revenue, but of that $50,000, only $11,000 is credit card processing revenue, swiped with a credit card in their place of business. Now, the average business owner pays between 2 to 5% of that total processing volume in credit card processing fees to their credit card processing company. So, if they processed $10,000 in credit cards that month, and they were going to pay 4% overall, that means that they're paying $400 each month in order to be able to accept $10,000 worth of credit card transactions and to have that $10,000 deposited directly into their bank account. The way that we make money is that of that total fees paid of $400, not all of it is direct cost. Much of that is profit. And we're going to get into that in the next segment. But again, remember that a lot of what the customer is paying of that $400 is profit. That's where we come in. We are able to set up a merchant to be able to accept credit card, or we can switch them over from their current credit card processing service, save them money, while still bringing in a profit for our business out of the credit card processing fees that the merchant is paying.